Hey everyone, and welcome to the Always On Point podcast here with Kristen Ambos, hosted by myself and sponsored by my company, Point Mortgage. So we are here today, and there's a lot going on in the world of mortgages, and a lot of that comes with, oil prices and things like that. So for something we haven't touched on too much in our podcast world is, what happens when the world and the U.S. economics start to really be a variable situation, right? There's a lot going on. And in this case, rates are moving. A lot of that happens that people don't understand. So there's a couple things that I want to unpack in this. So it just gives maybe a layman's terms explanation as to what's going on. So first and foremost, the Federal Reserve decided in March they were going to leave rates unchanged. That was no surprise to anybody in the mortgage business. Now, just a quick reminder for those of you listening, the Federal Reserve, when they change their rate by, 0.25% up or down, that does not necessarily affect the mortgage rates. In fact, now I'll say the last 4 times the Federal Reserve spoke, rates actually got a little bit worse than they got better, even when the Federal Reserve was lowering the Fed fund rate. Now, that's the rate they borrow money at. So think credit card interest rates. Think about, variable interest rates, home equity lines of credit. Think about, just the borrowing rate of money. That's what the Fed fund rate is immediately attached to. Now, when mortgages come into play, is attached to mortgage bonds. It's attached to the bond market, which is typically a lot safer of a place to put money. So investors invest in. Well, when the bond market or, just the markets in general start to react, the mortgages will follow that. So there was a lot of trading, a lot of sell-offs happening. And so with that being said, and the uncertainty and the volatility of the market, when that pulls back, interest rates go up. And that's exactly what you're seeing happening is, the jobs report. Now, we've been saying, and we follow on this, in this program, we follow Logan Montashami very closely. We trust him. I trust him. When he speaks, it typically comes to fruition. He's the lead analyst for Housing Wire. And, he's been talking about labor over inflation for a really long time. And I've followed that. I followed suit. So when the jobs market isn't doing well and inflation is still not where we need it to be, now you have a whole scenario, right? That's going to be, that's what mortgage rates are going to follow. And when you have jobs reports not coming in, you have economic reports not coming in, and you have a Federal Reserve who is uncertain, there's just a lot of uncertainty out there. And when there's a lot of uncertainty, everything contracts, interest rates go up. And that's exactly what you're seeing. Now, some of the oil prices we know are a lot to do with the Strait of Hormuz. And that being closed, we are filming this at the end of March. So next week, it might be open. And when this comes out, the Strait of Hormuz might be open, which would be wonderful, right? And if we can start moving on from this war, from this altercation, however you view it to be, it is a circumstance that's affecting our country greatly. And, when that goes to sleep and that doesn't happen and that's not the case anymore, mortgage rates aren't just immediately going to fall. Could they? Yeah, I suppose I never say never to anything because remember, we lived through the 2% and 3% rate era. We've also now lived through the 7% and 8% era. So that piece of it, I never say never. However, I'm not expecting them to be returned to any speed. Right now, as we film this, rates are right around 6.5 on a national level. You can go to Mortgage News Daily. That's where they're at. They're in that mid to higher 6s. Now, interest rates follow. Lenders are following that. So where, even 10 days ago, 2 weeks ago, I was quoting 5.875 on a purchase. Today, I might be quoting 6.5. They're up that much. So I just want you to know that that is a lot of that volatility and that uncertainty is what's driving that. Just because they, if they do open the strait and this war is done, whether it be a week or two from now, I still think that this is going to hang on for a while, right? Because we still have to open the economy. We still have to get jobs up. We still have to bring inflation down. And right now we're in an inflationary time. Whenever you have something that you can't get that you need, such as oil, inflation comes from that. So that's a lot of what's happening. I don't expect that rates drop back into the high fives, by the end of April. I hope they do. We'll see. I jokingly but agree. My crystal ball is only good for today. And you'll never hear me try to tell you, I know for sure rates will be down to this at this amount of time, because there's too much volatility to know what that is. So my crystal ball today says that rates are around 6.5. And that's exactly where they're at. I think that it's now still a great time. I'm meeting with people regularly to still get pre-approved. I don't know that going from 5.99 to 6.5 is going to break the market. I don't think it is. I also don't think it's going to save the housing market. I think that people who are going to buy. And those are going to be the people that win. They can always refinance later if rates come down again. So I think we're going to be in a very roller coaster ride for the rest of this year and into next year. At this point in time, what's being reported is that we're not to expect any rate cuts this year. We might even get a rate hike. Some of this rate increase that happened so fast, such a short period of time in the last 10 days, is potentially baked in already, expecting that. We say that in the mortgage world, being baked in. I also think a lot of times that the Federal Reserve is going to decrease rates. That's baked into the rates, and we get a lower interest rate 2 weeks before the Federal Reserve meets. That seems to be the trend. So we're feeling those moves prior to them even happening in preparation for them. So I do think some of that is going to happen, where we thought we might get a new Federal Reserve chair in May, which would then hopefully affect rates coming down in Q3 of Q4 next year. Those same economists are now saying those might be off the table and moving into 2027. I tend to agree with that. I think just everything that I'm seeing is showing that. So I think that that's a big piece of it. The other piece of the mortgage world, which you are going to be seeing and hearing about now, is servicing. So I wanted to discuss servicing because, I'm a lender who sells my servicing. You're going to have some loan officers out there that say, oh my gosh, don't ever sell your servicing, because when you sell it, everything, your taxes don't get paid, this and that. I can tell you right now, my own loan transfers and has transferred. I've never had an issue with my taxes not getting paid. It's the way you're set up. Even when your servicing transfers from one servicer to another, nothing can change about your mortgage except who you make the payment to. With that being said, you have a lot of large companies, such as, and it's been in the news, your top 5 IMBs. You've got Rocket Mortgage, you've got United Wholesale, you've got Cross Country coming in now, who are buying up and acquiring a lot of servicers. Summit Funding just got acquired. So no lender can look at any consumer and say, I will never service a loan. And none of them can look at the borrower and say, I will never sell your loan. Listen, local banks, people go to local banks and credit unions because they're writing the check to that bank, but that bank's not even doing the servicing. They're servicing it elsewhere because they can't keep that much on their portfolio. What a lot of companies are doing right now when they're acquiring other servicers or other small mortgage companies is because they either are profitable and they're trying to capture more of the market that they can. It's all a data grab, for one. For two, if they tell you they never service it, you don't know that case, because in a year they might have so much liquidity they start servicing it. A company I used to work for never serviced loans, is now servicing a large portfolio to keep up with the other large IMBs. Some of the other ones that don't sell and never have got into the servicing game and then left it because there's too much risk, there's too much payment. You have to have a really great staff and understand servicing in order to do that. I myself have had and worked for companies my entire career where servicing got transferred, and I've had great success with that. It's never been an issue for my clients. Most people at this point understand that no one lender can service your loan for the whole 30 years. In my career, 24 years now, I can't tell you how many times there have been huge companies at the top, then they've imploded, and then they've been acquired. Right? So that happens all the time. That's going to continue to happen. This business is way too up and down and regulations here and there. Some banks get it and they come in hot and they buy up the whole market and they win. Others do that for a few years and then you see them fade out because then they just sell to another up and comer They take all their money, the owners, and get out and go live luxurious lives somewhere and let them, go to a different owner, a different servicer. Summit Funding is one of those. I mean, great company. They were just acquired. You never know why an owner buys and sells. There's a lot of different reasons. And every time I get closer to the top and speaking to these owners and find out that, they're doing what the markets are telling them at that time. They're going with what they need to. And that's part of this business. That's part of CEOs changing over, leadership teams changing over. There's this cycle we're in now is a very balanced buyer-seller market. That's one we haven't seen in 5 years. So if you set up your company to work off of a complete seller's market 5 years ago, that's had to shift now. And what did you do at the top of your company in order to make those shifts so that you can survive the next 5 years? Did you make the right moves? Did you make some moves that you didn't understand? That's all at the top levels, but it does trail down to the consumer. And that's why I'm bringing it up to you guys is if you see your mortgage start to transfer between servicers, very common right now as different servicers are being acquired, as people are taking those data grabs. The big companies are getting bigger and bigger. And that to me, is cyclical as it was in 2005 and 6. It's 20 years later and we're seeing, just the ebbs and flows of the market. So market is still solid. I do not think that we're going anywhere. I think that rates are going to continue to stay stable. I think we might see some lower rates, but anyone who's told you that they think rates are going into the 4s, I'm skeptical of that right now. I'm cautious of that. I'm saying if you have a lower rate than where you're at, you can get a lower rate than where you're at now, and the new payment looks good to you, take it. And I've got 3 clients that I've worked with for the last 10 years that were hemming and hawing whether they should wait. We strategized. The second rate started to move up. They all locked in, and now they are getting into the low 6s on a refinance versus staying in their 7+% interest rate, hoping that we get into 5.5s because that might be next year yet. That might be another year. And so they took the market and they jumped on it when they could. That's my best advice to anyone listening right now. If you are over 7%, contact a trusted loan officer, get into the 6s, you still can, or strategize if your situation isn't allowing that right now, whether it be credit score, heavy debt load, whatever the case may be. You can still strategize, figure out what you need to do so that the next time they come into the 5s, you're ready to move and take that move then. Otherwise, it could be another year, 2 years, 3 years that you're paying a higher interest rate. Now, if you are locked into your interest rate and you can't refinance because it doesn't make sense, but you still want to get out of the situation you're in, find an extra $100 a month and place it on your principal. You can reduce your interest rate by doing that. Every dollar you prepay will be compounded to saving you money. So the more you can save, the better you can do, right? And so if you can just find that $100 a month right now, the best place to do it is put it onto your principal. Within 7 years, you're going to see so much savings there. And if this is not your forever home, but refinancing doesn't make a ton of sense, prepay your mortgage and utilize that as your savings account, because eventually you'll pay that mortgage off, you'll pay that house off, and then all of those proceeds can then be put down to your next house. Maybe you'll have a lower interest rate then, and now you've really made your money work for you. So those are some things I wanted to speak on because rates are going to be and going to continue to be volatile. I can't press that enough. Don't look at the interest rate right now. Look at the payment. Yes, interest rate is very, very important, but don't focus solely on that because then in the same you have flyers showing up in your mailbox that are promising you 4.99% right now. And I had a client this week that said, well, I'd like to get down to 4.5. 4.5 isn't on the rate sheet as of this week. 4.875 was, but even at that, she was probably going to be paying $20,000 in points. Did that make sense? Or does holding out and refinancing later make sense? Or does simply not paying $20,000 in points, but adding a payment every month to your principal save you even more? And in fact, in most cases, it does. I've ran the numbers with clients. I've done it over and over again. So strategize. The strategy, what you're buying now, strategize to what the next year, 2 years looks like. Where are your goals? And let's set that goal and let's set that money for that. That is the most important thing right now. So what I want you to take away from today is, yes, look at interest rate, but don't make every decision around an interest rate. Do it on payment, do it on what your future goals are, and strategize to get there. That's the best thing I can tell you to do right now, because what I can also tell you, if you're in the purchase market, if you buy when rates are a little bit higher, you typically have less competition. We already saw competition tick up for 2 weeks when it was at 5,875. All of a sudden there were 10 offers, 12 offers. If you can find a house you like right now at 6.5, there's a good chance you're not going to be into that competition. That's how many times people are pulling in and coming in. They're contracting and retracting into this market. So even though you feel like the rates are up a little bit right now and you're thinking, oh my gosh, the world is out to get me, the housing interest rates just don't want me to have a low interest rate. Not true. They want you to get into the house and pay the right price for the house, have your contingencies, and get an interest rate later that you like, that you can refinance to. Very, very possible. So key takeaways, yes, again, interest rate is important. Payments even more important. Your future plans and strategy is more important than that. There's a reason why financial planners tell you to start investing when you're 20 and not waiting till you're 40. There's a reason why we want to know that strategy. And things might change, but what we know is what we can deal with today and what those goals are in the future. And I want to help set you up for that wealth, finding where you can best use your money to make the most you can to set yourself up for later. Since rates aren't 3%, let's strategize on getting there. And those are the key reasons why it's super important. The market is going to change. It can change overnight. It can change multiple times in a day. Don't be surprised about that. Values and home prices are going to update. They're going to go up. They're going to fluctuate. They're not coming down. The last thing I want to tell you is this housing market is not going to crash. This is not a crash. We are still too low on inventory. When builders push back and aren't building, it's because the demand's not there. They're not going to keep building when the demand isn't there because they have to sell those properties. So when they're not building at as an aggressive of a pace, you know that means that the demand is limited. So what does that mean? It means that we've got a long way to go on inventory. It means that we still have a market that's there and we need more people to come into the market. More homes will be built. We are not going to implode on homes. You are not going to have a crash. You're not going to be able to steal a property in a few years. It's going to continue to go the way it is now, and we're going to continue to increase in value. Those appreciation, though, are not going to be the 5, 10, 15%. It's going to be, the 3, 4, maybe 5 on a good year. It's going to be a very balanced, healthy market. So now's a great time to get in. Now's a great time to plan. If you're thinking about it, get in. And again, work with somebody who's going to work for you and not just be a pencil pusher or a paper pusher to somebody else. Get the math done, have it right explained to you. It's the best thing you can do to protect you right now. Thank you guys so much for listening. We will see you next week. I am so excited to bring you our next one. Come back. We are going to have an amazing appraiser who is also an agent and an attorney. So she's going to give us all the appraisal inside, outside, upside down, and what you need to look for as both a consumer and a real estate agent as there's changes coming. And there always is in this mortgage world, this real estate world. So stay listening. If you haven't subscribed, please subscribe, because then when they are, the new podcast is dropped every Wednesday, you will get notified to listen. Thank you to all of our listeners. I appreciate you. And we'll see you next week.